And welcome to Paolo as well from University College London. I'm really glad, and it's an absolute pleasure to host Paolo here. And I wish you were with us in person, but maybe in one of the
Like,
future editions of a workshop like this, we'll have you here. He has done some absolutely fantastic work. By training, he's a physicist, and he has done a lot of very interesting work on financial networks, application of physics techniques from physics to socioeconomic systems. And when I invited him, part of the idea was to relate networks to one of the topics that we sort of laid on in terms of dynamics and then eventually quantification of systemic risk. He has a very nice review paper on that, on relating to financial ensembles and networks. So I'm really glad that he accepted the invitation to speak in this conference. I think Paulo has one, if some of his first papers, I think, of research life was done with Giorgio Parisi, if I remember correctly, right? So Parisi is this famous Nobel laureate in physics for working on complex systems. And currently, again, Paulo is working a lot on network-related stuff from a physics angle. So I'm sure there will be a lot of food for thought here. And Paulo, you cannot see the room as a whole, but there are many students and researchers, active researchers, who would like to know more about networks and systemic instabilities and how dynamical system fits into the theory of dynamic network models. So with that, I'll hand it over to you. You will have roughly 57 minutes from now, and you can there may be a lot of questions on your talk, so maybe you can keep maybe 5 to 10 minutes for that. That's as a request. Thanks, and over to you.
thank you, and thank you for the lovely introduction. I'll try to keep up to the description. And so, yeah, thank you so much. I hope you had a nice lunch break. And so today's topic, and I'm gonna cover it's networks and systemic instabilities. And I'll start with a short motivation. So this is the summary. So I'll start with a short motivation introduction on the general stability of dynamical systems on networks, on in general, on depending on some kind of interaction matrix. And this is the general motivation for me to study networks in so many systems, and particularly in financial systems. Then I'll kind of review a number of results. So it will be kind of a summary of different results. So if you have questions on some specific papers, I'm happy to take questions on some of these results. And this will cover mainly on one side the structure of the network, so core periphery, bipartite structures, and the dynamics that happens on the network. So that is mediated by the network links. So network valuation in financial systems, it's more related to the question of how to assess systemic risk in a financial system, of course, with some specific kind of financial instrument that is shared by the participants. Then the results will go more towards a bipartite, a common asset holding network. So this is kind of the quintessential kind of example of bipartite networks where you have financial institutions and holdings, so stocks, commodities that they're holding. So clearly two separate kind of links, kind of nodes. And then I'll move on to models that are more specifically related to dynamics, so temporal network models. And when you don't have a static network and you cannot assume that it is static at any level, and you need to start to develop a model that is dynamic in the sense that the links of the network are changing over time. They are associated with some timestamps, which may not be even synchronized. So then you really want to have some kind of specific modeling of the edges and associated with their timestamps, and I'm approaching that with Oakes modeling in the last few years. So starting from motivation, so from my side at least, it's the general stability of dynamical systems on networks. I think this is of course related to a very prominent papers you may have already cited during this workshop, which is the Robert May's paper on stability of dynamical systems. And in that case was a study as a dependence on the size of the system in itself. But in general, a question that I've been asking myself lately is more related to the heterogeneity. So it's with a large heterogeneous system on a network, just to be related to today's topic, be stable. So this is a very general question that you may kind of ask in different ways, in different dynamical systems, and you may get kind of different answers depending on the dynamics, of course. But this is kind of a general motivation for me to study networks and dynamics on networks and dynamics of networks. And again, just to give just a specific question that is emerging in a recent paper, it's related to criticality. So, and of course, I mean, it's studying systems when they're stable. It's interesting, but it's very interesting to see how they approach instability and what happens at instability. So when they get less and less stable over time, and what happens at the stability transition. So how they change after they reach instability. So that's of course another important question in the sense that we observe in lots of systems, maybe the systems you also study in your research have kind of large fluctuation and have broad distributions. So the question is, how do you get from a Gaussian kind of a distribution to power law distribution in different systems? And this could relate to criticality, so to approaching criticality in many systems and approaching instability threshold for then the system to change and go in a different phase. So this is just to give like when I talk about networks in the next few slides, I will try to have in mind a dynamical system. And my kind of go-to dynamical system is a stochastic one. And this is this Ornstein-Uhlenbeck process. So I often kind of think of the network as some kind of interaction matrix and acts on some sort of stochastic dynamics on variables that sit on the nodes. And sorry, here, of course, the sum is over K, not over J. And you have interactions for this matrix, AJK, XK, sum over K. And then in this case, and this relates to the heterogeneity aspect, which is the specificity of my question, and it's related to the fact that the noise in itself is not necessarily like delta correlated, but as a D matrix, which is a diffusion matrix that's not necessarily like a multiple of the identity. So it's not necessarily just a temperature, but it's a full matrix that it's may have heterogeneous temperature. And recently, I mean, of course, there are many studies you may cite on this kind of system. And you may think of it as a stochastic generalization of the May question. And recently, there's been this paper by Krumpeck et al. On fluctuation spectra of large random dynamical system. And I think what was interesting for me, at least in this specific paper, is the fact that okay, we're thinking of a linearized system, which may look like a strong assumption, but of course you can always think a nonlinear system, nonlinear with some kind of f function that relates all the variables, and then you take a linearization of the system close to a fixed point. And then it makes lots of sense to think about, okay, when am I reaching instability of this fixed point? And then maybe my nonlinear dynamics will step in, and then I will reach a new fixed point. So you can think of it as kind of this temporary stable dynamic or stationary dynamic around the fixed point, and linearized dynamics around the fixed point of a nonlinear system. And then you may study fluctuations around this fixed point of this nonlinear system. So even though you have a nonlinear system, you may kind of look at this linearized version again with the sum over K to kind of make sense of what's going on. And the A matrix, which maybe often could be sparse, so it could be related to a specific means of communication between flow of communication between the nodes that kind of gives constraints on the spectrum of this matrix, because of course, and this is the kind of aspect that it's interesting for stability, is the fact that you try to look at the minimum lambda or the minimal real part of the lambda of the eigenvalues of the matrix A. And recently we studied this with this specific ensemble with a few collaborators, and this is currently on archive. And again, this is kind of the system I'm thinking about when I study a network and I want to kind of check what kind of dynamics should I expect for this network. So now I move on to actual network models. So it's more about kind of the understanding and the emergence of network models in real systems. And a go-to network models, of course, is the fitness model, which you, of course, may have covered already. In this case, I summarize it in this way with these fitness variables, which are these theta variables. And of course, what's convenient here is that you have binary kind of values for the A matrix again. So we keep the same notation. Potentially, as you can see here, you have a T, meaning that this could vary over time. You could have different snapshots. But again, it's static in the sense that we are not coupling different snapshots. So each network over time is a separate network, and you can get fitness values that are completely different from one network to the next one. Okay, so one node could be very relevant in a snapshot. It could be completely irrelevant in the next one. So there is no autoregressive part, no link copying happening in this model, as you can see. And so I could take the product over T, and this would be completely independent. Okay, so this is a kind of a classic fitness model. Another ingredient of static networks, it's if you want, it's kind of complementary to the fitness value, which is node specific. It's the block model, so where you group together nodes into blocks that have a similar behavior. And in that case, you can think of the group as being a node property, but then of course, once you have the group property, the node property, which is a group, you then have a probability of link that is no longer just depending on the node, but is depending on the block. And this is again in the context of statistical physics applied to networks. This is a prominent example of how you can study an interesting graph theoretical problem, and also with statistical physics. This is a well-known kind of cavity method approach or belief propagation approach to study the transition, detectability transition on the right-hand side. Because once you have these blocks, and you can think of these blocks now as being blocks in the network, blocks of nodes that are deeply connected, like clusters of nodes. And as the probability of connecting two blocks increases, then of course you get, if the blocks get more and more connected, then you can no longer distinguish the blocks one from each other. So you have the detectability transition, where you can no longer detect the clusters, and that's what happens. And you can see that that's a sharp transition that happens to have a given ratio between C out and C. So expected number of links that are outgoing, and expected number of links that are in the given block. And this is just to give you how it looks like. Now you have a random network, and then you're able to sort nodes in a way that make it clear that you have a block structure. And if you're curious about this tool, I mean, one of the prominent examples, there is a researcher who's been working on this for the last 10 years, was Thiago Peixoto, and he's been developing amazing tools, and graph tool is probably something you've heard about already or used already. And why I'm talking about this in the context of financial networks is that like a prominent example in financial networks is the emergence of core periphery structure. And of course, it's not restricted to financial networks. This is kind of a signature of any kind of hub periphery, peripheral node structure. It's kind of a like something that can emerge every time you have some sort of power law structure or preferential attachment mechanism, richer effect. You may look at it, and it may emerge as a core periphery as well. So there is this element of how do I distinguish a core periphery structure from a richer preferential attachment process in my network. It's kind of it kind of depends on the definition, but I guess core periphery in itself it can be regarded. You may think of it as a block structure, meaning that you have nodes that are indistinguishable in the core, and they're all similar as being part of the core, and you have periphery nodes that are indistinguishable in the periphery, meaning that they're all part of the periphery in the same way. And the main characteristic, as you may understand, is that you have a core-core interaction that is very strong, as you can see from this kind of picture taken from a paper by Daniel Frick and Thomas Lux, which was one of the first papers to identify it in an overnight money market. And you have a strong core-core interaction, and then you have, as you may guess, a periphery core interaction, which could be directed. So it could be that some peripheral nodes are directed towards the core, and some other peripheral nodes are more receiving links from the core. And then, of course, the periphery interaction are very sparse, and so they're almost absent. No, it's very hard to go from one periphery to another, as it's the case for networks. So once you're in the periphery, it's very hard to go from one side to the periphery to the other side of the periphery. And that's the characteristic of the core periphery structure. So you can define different algorithms to identify a core periphery structure, but as you can guess, and was found in the literature some time ago, is that this is extremely strongly correlated with the degree. So meaning the number of links of connections you have. So it's pretty straightforward to rank nodes in a way that it's kind of already reflecting the core periphery structure. But you may find some algorithms that work better than others. We studied this with a group in Pisa, also with Fabrizio Lillo and Daniele Tantari, and we found that it's possible to find algorithms that are tailored to identify coreness as opposed to centrality. And just to give you, again, in the spirit of the workshop on statistical physics, you can build an interesting cavity method and cavity model, meaning that you can build a set of cavity equations, and of course I won't get too much in the detail, but these are kind of the diffusion variances for the Gaussian model that build the cavity equations. And in this kind of model, you end up with the possibility of having just a few variables, as you can see here, based on the blocks. And then you're able to reconstruct the full probability distribution of the network just from these diffusion variables for the Gaussian model, and with these cavity equations. And the nice thing that with this cavity equation, you can end up with a nice, for instance, closed form solution for the spectrum of core periphery graph for equitable core periphery, which is a specific class of random graphs that are stochastic block struct with a stochastic block structure, but with a regular constraint of the number of links. And you can find spectrum that spectra look pretty much like this one, which I included in this presentation because it's kind of a extension of the McKay law for regular graphs, which you may find when you have a regular graph with k neighbors. So you have a established McKay law. In this case, it's a core periphery with a core that has k neighbors. But then you end up with this interesting gap for zero eigenvalues, which is something, again, that wasn't present, of course, in a regular McKay law. Now, one finding from my colleagues and I on this core periphery structure is related to the fact that actually, when you take into account asymmetry and the degree heterogeneity, as I was saying, you may find that core periphery is not the go-to structure in all financial networks, as previously found in the other papers. And the point is the following. So, as I was saying, when you have a strong degree heterogeneity and you have some nodes that have more connections than others, you may be tempted, if you use a clustering algorithm, to just group together the nodes with a high degree. That's the point. So you put together in a block the nodes with a high degree, and you put in another block nodes with a low degree. And that may make sense, and it may give you a good fit because it's kind of a fitness model, and it kind of works, of course, in terms of likelihood. But then, if you actually ask yourself the question, what is the best block structure condition on the fact that these nodes have a given degree, and then you find that actually the core periphery the structure is not necessarily the best, and you may find structures that are more also related to what's going on in the given network. So in particular, in this example, you have a bipartite structure. And by bipartite, I mean that the nodes are still the same kind of financial institutions, but if you see here, this bottom left part of the adjacency matrix. When you see red or blue, it means that there are links connecting weighted links connecting a given block to the other. So it's more. In this case is going to, you may see that from the second block to the first block. And if you look at columns and rows, rows and columns, and the point of this is that in a financial system, it could happen that, as I was saying, that you could have periphery nodes that are borrowing or lending money to the core or to another group of nodes, and you have a flow of kind of financial transactions that are going from one block to the other. And this is something that you didn't recognize with a straightforward core periphery structure, which looked like a core periphery, but was actually hiding in a way through the degree this kind of directed bipartite structure. So this kind of was a finding that degree correction can help you identify better or more interpretable structures in financial networks in this case. Reflecting a financial behavior. Well, of course, because if you have some financial institutions that are borrowing money and others are lending money, these are two different behaviors. And if you mix it together in a core, you're not understanding what's going on and what they're doing in that financial system. And as a follow-up of this finding, what we did is also try to follow up these strategies and follow these strategies snapshot by snapshot, and checking whether a given institution would change the behavior over time. And in particular, there was this, of course, in 2012, there was, of course, in Europe, there was a specific moment where there were LTRO measures, so measures for helping the banking system that was struggling. And in that case, the EMID this money market where there was this kind of short-term loans between banks and that are kind of clearing their accounts by the end of the day by asking for money in this money market, would have a specific behavior before the 2012 and then another one after 2012. And this plot here is showing you that they were maybe behaving as borrowers, as net borrowers in this money market, because they needed maybe the money by the end of the day. And then from these 2012 measures, they started lending money in this money market. So there was quite an abrupt change of their behavior in the money market related to this that correlates with this measure. So of course, we didn't do a specific causality study, but I guess you can see that some measures may confirm this just by looking at the plot. So that was something that again, it kind of goes on the same line and same take-home message, that identifying a good network structure with a good null model can help you interpret what's going on in the system and give you a direction on whether also there is a change in strategy and behavior of institutions in a given market. And for the topic of today, I also wanted to kind of introduce another topic that is also part of the review that you mentioned, so on financial systemic risk. And so I need to introduce a few more elements to kind of explain that. And of course, I'd be pleased if that's something, another take-home message from today. So this is kind of a different banking system, and there's a common way of modeling the balance sheet for banks, and it's both present, of course, in the finance literature and in the systemic risk and network literature in terms of modeling assumption. And basically, you have an assets and liability structure, and you can think of all institutions having some sort of external assets that are external to the banking system. It could be also just a stock market, or any kind of assets that different banks may hold depending on their business model. But then they have this A, B, and LB, which is the banking system assets and the liability in the banking system, meaning that they have contacts between each other where they lend or borrow money from each other. So if I lend money to somebody, I will have an asset, of course, because I'm assuming I will get back those money. If I borrowed money, then I have a liability because I will need to get those money back at some point in time in the future. And of course, to ensure and to evaluate the risk of each institution, there is a common measure, which is also referred as the leverage, which is essentially the ratio between the assets that you have on the left-hand side and the equity on the right-hand side, the green box. If you can think of it now, the green box is the difference between the assets and the liabilities, and the bigger that is, the more kind of you're in the money. You have very much confidence on the fact that you have lots of equity in your, and you have so many more assets than liabilities. So you're kind of very well in terms of security. Of course, from a financial perspective, that might not be the best situation to be in, because you want to be able to be exposed to the market in a way that so where you have a leverage. So that might not be the preferable way, just to maximize the leverage, so maximize the equity. But in general, you have this ratio, which is, again, take a message, the total assets divided by the equity. Specifically for the banking market, you can just take the total assets in the banking market, so AB divided by equity as a very important quantity in the leverage and of the banking system. And of course, regulators tend to regulate this leverage. Regulators tend to regulate in general, but tend to regulate the value of this ratio, the assets over equity. And once you have that, you may think, okay, you have this system, but what happens if the blue box goes to zero? Okay, goes to zero. And if you think of it as a geometric barrier motion on any kind of stochastic process, AE could, for instance, at a given point in time in the future, go to zero. And if that happens, as you can see from the image, quite simply, you can see that the liabilities may become more than the assets. Okay, and then that means that the equity is becoming negative, which again, it's something that banks don't want. You want the equity to remain positive. So that's a scenario where you may incur may have some sort of default because you don't have enough assets to cover your liabilities, and that's, of course, that could create a chain of contagion. So basically, the default can cause default for other institutions as well. Now, the modeling of this, sorry, I've included this slide with a lot of equations just to show that there is some kind of mathematical modeling here. It's not just a nice picture. But also the point here mainly is the fact that you find this old friend, so this AIJ, you still have this matrix element. And for those familiar with PageRank and on other kind of centrality measure, in a way, we build this system having in mind a sort of fixed point. So if you forget for a second about the Q measure or the P measure, again, I'm also a physicist as a background, so it's not my bread and butter. It's something that we had to do for this financial modeling. But the main point here is that you see that you have the equity on the right-hand side and equity on the left-hand side. Let's forget for a second about the T and the time dimension. So the point is that you have some sort of fixed point that is emerging here. Okay, so this fixed point is essentially close to a PageRank kind of measurement. And in fact, one of the main innovations in this field was called the depth rank, where you have this kind of process with a specific choice for the nonlinear function that couples the different equities. But again, so for the sake of today, you have this kind of fixed point equation that is depending on the matrix. So it's some sort of centrality measure that is depending on this nonlinear function for the equity. Now, we built something that we believe it's a good set of assumptions for the assessment of this valuation of the equity, which basically is associated with the fact that the more equity you have, the safer is the asset for the institutions that hold assets towards you. So if they're expecting money from you and you have an high equity, I think they'll be safe, and the valuation should be pretty much face value, so at 1. If your equity is going smaller and smaller, and the expectation is that it is getting smaller and smaller, then the valuation of your counterparties might go closer to 0, and then they may assume that the assets they have, they're actually worth almost nothing. No, it's a discounting factor. So it's a discount factor. So that's what we do here in this network valuation in financial systems. And this framework was useful some time ago also because there were a number of methodologies that were kind of confusing, also not confusing, but kind of separating the area of defaulting banks in the banking system, which is not something that luckily is very common, and distress institutions. Distress institution is happens very often. So in this framework, you're able to account both for real defaults, where the equity goes to zero, and for distress. So when the equity is just stressed, like in the debt rank. So when the equity is still positive, but it's going down. So in this framework, we were able to account for both situations and to obtain reasonable mappings with previous models. And in this line, I guess a few years ago, we collaborated with Marco Bardoscia, who was a researcher with me in the same institution, and then he joined the Bank of England after all part of his research, and we managed to kind of account for this solvency contagion risk, which can be evaluated with the model above, and with the same framework, we just have a specific choice of this nonlinear function. Which includes a probability of default in the sense that I just told you. So the fact that the equity could go to zero, and the recovery rate rho. So if you default, it doesn't mean that your counterparty lose everything. They may get a given ratio of a given fraction of what they were owed. And this is a study where you can kind of plot for different banks in the banking system their different valuation functions, so they may differ also in the sensitivity to the change in equity. And also you can see here that based on the data that we had, essentially the instrument was less traded, so the main part of the contagion losses would go down because there were essentially less links in the network and less contagion risk in the network. So there was kind of a clear effect of the also you can call it as a quality improvement in the instruments that the banks were trying to trade, so that they were more secure. Now, combining these two elements, hopefully, so as you've seen in this first part of the talk, I was mainly focusing on some static networks, so fitness model, stochastic block model, and combination of the two, the so-called degree-corrected stochastic block model, which does the operation of not disentangling high-degree nodes from the block structure, and the network valuation, which is again a dynamics that happens on the network, which is a fixed point, which is a function of the network in itself. It's some sort of centrality measure that is financially informed. And in this case, we combine these two in this collaboration with a number of researchers that are now scattered all over the world. But in particular, also with Giulio Cimini, we thought about this study by putting together these two elements, the degree-corrected stochastic block model and the network systemic risk measure. And we try to have a clearer picture, because the question is, okay, we have different systemic risk measure, but how do they vary when we vary the network structure? Because that's I guess the typical question that you ask in network theory. And we could kind of the point is that it depends. Unfortunately, you don't have a very unified answer, single answer. You would like to have that, but often it's a bit more nuanced. And what we can see here on the left-hand side, I guess it's a good summary of the structure that I was talking about. You may have a case of a system which is essentially core periphery with a strong degree for some nodes and low degree for others. And then you may have other system where you have two blocks which are essentially two hubs that are connected together. So you can see that here you have a strong link between the two. And then a more bipartite structure where you can see that the off-diagonal blocks, this presentation is going from this is 0, 0 here, and they're growing like this. So it's kind of it's rotated by 90 degrees with respect to the previous representation. And in this case, you have this off-diagonal connections between the blocks that like look like this in like a bipartite structure. And so changing, of course, the financial network structure, you may have different kind of profiles of risk depending on the density and this is another kind of take-home message of this specific paper. Also, the kind of shock you consider may vary a lot. So the results. So that's another factor to consider when accounting for systemic risk. Unfortunately, systemic risk is a very nuanced topic, and it's hard to give one answer. It really depending on the specific notion of systemic risk and shock scenarios you want to consider. So this is I guess the take-home message of this is like, of course, it depends on the network structure you have in your system, but it depends also on the profiles of scenarios you are considering for your system. So that can really vary. And of course, if you have a strong disagreement on the scenarios you should consider, you may not agree on the systemic risk valuation for your system. So that's something to keep in mind for policy recommendation. For today, I also wanted to mention this study, but I won't take too much time. The main reason I wanted to mention this because this is a real bipartite structure. This is a study where we study common asset holding, and it's a collaboration again with the Bank of England, with Tahir Mahmood and Laura Silvestri. And in this case, the question was, how similar are institutions when they're actually buying commodities and different holdings, equities and holdings, and whether community structure reflects the different kinds of financial institution, or you may kind of have institutions that of a given kind, insurance company, but they behave like hedge funds, for instance, and in the sense that they're more similar to hedge funds than to their own other insurance companies or banks. So we found this kind of mixture. We found that when looking at equity and debt holdings, you may find insurance companies that behave like funds, and that depends also on some specific regulation for open-ended investment funds and insurers in the UK. And this is kind of the bipartite structure that emerges, which is of course very. This is just to show the kind of the rich data set that was present in the Bank of England. This is not to represent any specific core periphery structure in this case, but it just gives you an idea of the kind of overlaps that can emerge. And this is the centrality analysis that we applied, where you have a similarity measure. So you have a similarity that you can reproject now the bipartite networks into a monopartite networks and identify communities. And as I was saying, the point is that you can have behaviors of financial institutions that are more similar to other institutions other than the same. In particular, for this data set, there was this non-unit linked insurers versus unit linked insurers. So I don't know if you're in the insurance kind of business, but this is a very specific finding of this research. But also, what we did in this study was combine this portfolio similarity as a measure of potential risk, because the overlap on portfolios could reflect the fact that we have a common liquidity risk. Because if we hold the same stock and I'm in distress, you are in distress. You may be worried because I may need to sell abruptly the same stock you hold, and that may be reflect negatively on the price of your asset. I also wanted to mention this paper, but I will really briefly, and then I'll move on to the temporal network side of this talk. Just because, again, of course, in the last few years, as part of the UCL group, so the University College London, we had the chance to collaborate with the Central American and Latin American institutions, again, to kind of use these financial networks background and machine learning background that we have at UCL to help kind of develop new research programs and new tools potentially internally for different central banks. And one aspect that was studied in this case with the Bank of Colombia was the fact that it's possible, of course, to have network features in the banking system, in a payment system between financial institutions. And you can, in this case, there was a specific set of 113 features that was developed by the researchers at the Bank of Colombia that allowed you to identify different institutions and potentially lead to anomaly detection, in the sense that when you're unable to identify an institution as itself, then it may be that it means that that institution is having an anomalous behavior, and then you may want to check why that is going on. So in a way, it's a study of how unsupervised methodologies can help you in provide an anomaly detection tool for payment systems. And this is again, I won't dig too much on this topic of multi-layer perceptron, but the idea is that you can have a graph structure that is then linearized in a set of payment vectors, and the idea is that you then have a trick, meaning that the input-output structure is just given by the payment of a given institution, and then the classification is the institution itself. So you don't have a real supervised data set, but you create one just by matching the payments of a given institution with its label. So then you have a classifier that allows you to look at a vector of payments, and get the corresponding institution. Okay, so you have a supervised methodology that allows you to kind of overcome the fact that you don't have a real supervised system with input output. In this case, so you have the payments and the label of the institution, and that was possible to do, and it kind of gave very clear results on the fact that it's possible to learn this classifier and to teach this classifier how to recognize a given institution. And then, of course, once you have that, you have a tool that, as I was saying, can tell you whether an institution is behaving like itself or not. And then that could lead to an anomaly detection tool for the bank. Okay, so that was this first part. I wanted to cover a few static network approaches, even if the networking itself could vary over time, but in a snapshot mode. So these were all tools that could be applied to a given network. Now, the financial network systemic risk measure, the network valuation, the depth rank that I mentioned, the clustering algorithms, the block structure algorithms, and the systemic risk on different networks. It was all applied to a static network. Now the question is, okay, in financial systems, if you dealt with some kind of data, even if it's not financial or it's economic data, you know that they usually associated with some kind of timestamp, and you kind of aggregate this data in your Excel file or in a given CSV file, and you put them together as part of links of the same network, and in a static form. But that strongly depends, of course, on the range of time range. So whether that makes sense in a given time range, if the links are sufficiently synchronized, and they may be synchronized also in sense of financial contracts, maybe in the time of they start and the time they expire. Maybe that it makes sense to consider them as associated with the same timestamp. In some other cases, that's simply not possible, and it's a strong assumption to kind of aggregate payments at the same time and not to have some kind of time discount or some sort of time varying average for your network. Now you can do that. So create like a moving average network from your data. But in the following slide, I'm trying to kind of develop tools that are more genetically temporal, in the sense that you have a genetic structure for generating networks that have an arbitrary timestamp. And of course, this is an interest in the context of statistical physics, network theory, but recently also, of course, on machine learning There is a growing interest in graph neural networks, so on static networks, but also on networks that have a time-varying structure. Now, let me just clarify the snapshot models word. The idea is that you have this kind of window, which could be a daily window or an hourly window, or any kind of time frame that makes sense for your system. But the point is that you have a sufficient number of links that are synchronized and they can be part of the same box and then become part of the same network. And then once you have these different boxes and different kind of snapshot of networks, you can then ask yourself, what is the process that brings me from this set of links to the next set of links, and so on and so forth. So this is kind of the snapshot approach. So there is no, you lose the idea of the timestamp of each individual link. You just have a box of links that falls in the same time range, in the same day, on the same hour. So once you have that, you can develop a number of models, and this is a number of those. This is the directed, discrete autoregressive processes, the SSI, this is what I call the single snapshot inference, the temporally generalized random graphs, the DAR TGRG, or a general nonlinear regression model that could be a machine learning model, but with the snapshot feature. So just to give you a few more details on these models. One, this should be, again, if you're familiar with the discrete autoregressive models, in particular, if you're familiar with the autoregressive AR1 or ARP, this is kind of intuitive. Like you have the next link, in this case, for the efficiency matrix, is just a Bernoulli trial, where you say, okay, the next link is the same as the previous, whether you have it or not, plus a new sample, a new sampling of the variable, which is, again, YT. So either I copy, in a way you can think of it like this, either I copy the link or non-link from the previous snapshot, or I resample it. Very clear. So hopefully very clear, but in a way very simple. So the idea is that you may copy it or resample, and of course you can decide to fit this model, and this will give you immediately some kind of measure of how much copying there is in your system. If your system is always the same, the variable v is basically always 1, and basically the matrix never changes. So it's essentially a static network. But in some other cases, there might be much less copying and much more variation on the resampling. And then you want to know what is this ratio in your typical network. Now, this is DAR1. Sorry, you may have DARP, meaning that you copy randomly from your P previous steps. So this is a typical example, it's kind of simple autoregressive model. Then let me go back to the model that I actually partially already presented in the fitness model. But in this case, you see that I have the fitness variables. So if you remember the fitness model, you have a fitness variables here. And then I also have some kind of autoregressive term in the values of the fitness. So the idea here is that there is a memory in the fitness parameters, but there is no link copying. So you see that these are kind of orthogonal models in the sense that one is keeping the features of the hidden variable. So you can think of it as a latent space model as well. And the other one, it's copying links. So it's actually not latent at all. It's considering the previous links and deciding whether you want to copy or not. Now, of course, you can think of it as combining the two. So this combines the two models I presented just now. So you have the latent space fitness model memory, meaning that the fitness, so one node that was important in the previous step needs to remain somehow important in the next step. And then you also have a copying mechanism from the previous snapshot. And so you have this kind of two mechanisms happening at the same time, and you want to know how important they both are. There is no block structure here. You could include a block structure, but as you can imagine, this becomes very, like the parameterization becomes very heavy. And in this case, the main point is trying to understand how better you can get by accounting for these two mechanisms at the same time. So that you can provide an expectation maximization to infer the values of alpha and theta. And as you can imagine, given a set of theta, you can find a set of alpha. Given a set of alpha, you can find a set of thetas until convergence. And this was done in the context of preferential trading. And the idea is that preferential trading is the fact that you have copying, a lot of copying mechanism, and meaning that you're copying previous links. And while non-preferential would be just related to theta, just related to the fitness of the banks at a given point in time. Now, so this is the interpretation that we've given. So alpha is kind of related to a preference of copying previous relationships, and theta is related to the fitness of the bank at that point in time. So this was possible to fit in for instance, again, in the IMID dataset, which is like a prominent money market dataset from now 10 years ago, but was used extensively for testing this network model in finance. And it's possible to kind of estimate these fitness values that correlate, of course, with the bank exposure. So that makes sense. And it's possible to kind of evaluate these different models and to see that, for instance, now the combination of the copying mechanism and the preferential and the theta fitness model it allows for a better area under curve in this case. Okay, you may arguably you may have also a model selection here, of course, because you have more parameters in the second case in the DAR TGRG. But I think we included that also in the paper. But the point is that yes, you can have a more predictability for the system with these two elements in line. Now, for the I want to allow for a few questions, so I will just move on this on the next question, because this is a very similar model with respect to the previous one. You can see that this is a strongly DAR like a DAR assumption, essentially, with an extra term UIJT in this case. But I won't enter
So,
the
Paolo, you
details of
have a
that term.
few minutes from now. So,
Okay.
just to ensure that there are some questions as well.
Thank you. Yes,
Yeah.
absolutely,
Okay.
absolutely. I'll try to keep it in 1 minute.
Okay.
So here I just want to say one thing that we started asking ourselves the question of the dependence of the eigenvalue, and that relates to the stability question. That's why I think it's important, because we started to ask ourselves, okay, what is the eigenvalue of the matrix we are creating with this dynamical system, and how that is affected by the different entries of the matrix. So in a way, we wanted to compute the marginal effect of a link to the eigenvalue, and that's possible to study. And we've shown that the different matrices can have a different behavior with respect to the dependence on this structural measure of the importance of a given link. This is another study that you can find, and I'm happy to share it, and that relates to the lambda dependence with respect to the behavior of the temporal network. Finally, Oaks processes. The idea here is to have a timestamp dependence, as I was anticipating. The idea here is that you have a likelihood, you have a continuous model, you have a lambda, which, if you're familiar with the Oaks, is basically a Poisson process with a lambda that depends over the past events. So your kernel phi is integrating past events, and that gives you the excitation or the inhibition to then create more events and more links in your network. And this creates kind of, you can have a multivariate Oaks process. And in the context of network, this can be interesting to understand in this case for transaction networks. But just as a last point, this could be related also to the study of Oaks process for temporal networks modeling. That's something that I think we've been discussing as well. And we have a preprint almost ready. And the point is that you can have some structure in the blocks that emerges from the Oaks process that you wouldn't get with other models, and that can give you a new interpretation of your temporal network dataset. Thank you so much. Thank you for your attention. And yes, hopefully I'll have a minute for questions. Yeah.
Hi, Paolo. This is Shitabro, one of the co-organizers of the meeting. Great talk. So, I was just wondering, like, we have this paper in which we showed that bipartite can be generalized to a whole class of anti-modular networks. And so in principle, you can take a directed weighted bipartite graph, compute its Q value, Q being the Newman measure for modularity. And if it's close to -1, that means it has clear bipartite structure. So I'm just wondering whether you tried to apply this kind of technique on a real financial network and show that it's indeed bipartite.
Thank you. No, I haven't applied directly the modularity maximization or the modularity minimization. I think, as you're suggesting, I guess from your study. No, I didn't. I think for the example I showed, I guess the take-home message there is that if you don't account for the degree correction, so if you have a degree corrected modularity maximization or minimization, so I don't know, with some kind of normalized Laplacian or something like that, then I think you would get the bipartite structure that we find. If you don't apply the degree correction, I think you may still end up with some kind of core periphery structure. But yeah, I'd be curious to see the modularity minimization or this anti-Q algorithm to see what are the results with and without the degree correction.
Okay, thank you.
So I have one question.
Yeah.
The framework that you showed about distress, right? So you generated this page rank like centrality measure. How is that differ, or what is the difference from the Guy Kapadia? Like they also did a fixed point, and they also had this spillover of distress from financial institutions to the others. So is it the case that in their case the spillovers are kind of binary, like one bank either goes bust or not, whereas what you have is continuous? Is that the difference, or are there some more differences?
In short, I would say in physics terms, yes. From a financial point of view, I would say that yes, the difference between default and distress, it's quite relevant. It's quite more general and opens a few more problems than just continuous versus not. In the sense that you need to account for the stochastic process, so the whole Q measure question, because then it's much more about when is the default happening. In one case, I think, if I remember correctly, the Guy-Kapadia measurement is a default contagion process and evaluation. In our model, the idea is that the default may happen in the future and may never happen in the future with a given maturity in time, but we are accounting now for the potential of a default in the future, and that's the distress that we get. And to do that, you need to account for the stochastic process. So you have a number of ways of dealing with that, with a Cox model or with a Black-Scholes, so with other models. And then the evaluation may really vary. So I guess the decision, how do you to make it continuous and how to make it equity dependent, let's say, it becomes like a loaded financial question. So while I think in the framework of defaults, it's all much more mechanic, and it's much more like a mechanistic propagation. In our framework, an open question for me, it's also how the information propagation occurs exactly, and because there are lots of information asymmetries that may emerge. Again, in the default scenario, you may argue that that's again mechanistic, because if an institution is default and everybody knows.
And also just a follow-up question, that in their framework, I think it's a fixed point on the static system, whereas in your case, it's a fixed point of the dynamical equations also that you are presupposing that governs the evolution of equity.
So if you refer to the dynamic of the AIJ, so the fact that the AIJ is t-dependent, or you're referring to the fact that there was a t-dependence on the equity?
T-dependence on equity.
No, so I guess, thank you for the question, because that allows me to clarify that. So the t-dependence on the equity is not a t-dependence in the fixed point. it's a t dependence, which refers to what I was saying earlier. So it refers to the fact that it's an evaluation of the equity at time small t, as opposed to the
I see.
evaluation of the
Okay.
equity at time capital T, which is at maturity.
Okay. I see.
So there is no dynamics in the sense that, I mean, you of course then you solve it with some kind of iterative dynamics, but the idea is that it's a fixed point where the point is that the right hand side, it's the valuation of the equity at time capital T that we do now. So
I see.
it's the discounting of that valuation, but it's everything happens at a small t, as in an
I see.
economics framework. So everything happens at a small t in terms of the valuation.
Excellent.
So there is no dynamics in that. But thank you so
Yeah.
much. That was very important to clarify.
All right. So let's put a round of applause for this great talk. Thanks, Paolo. And we hope to see you again. Yeah. Thank you.
Yes.
All right. Have a great day.